Good afternoon, everybody, on this beautiful hot summer's day, and welcome to an hour's chat about death. There's a build-up for you. This is the fourth in the series of the special Utmost How-Wows that we're running this summer. The fifth one is next week. That will complete the set. And if you want to do a bit of a binge watch and a catch-up, there's a link to the very useful Utmost page on their website, which has got links to the previous events and this one and the future one. If it's the first one you've been to, then welcome along. Why are we doing these? Well, we went to the paraplanning community a few months ago and said, what would you like us to do? And they came back and said, well, a whole series on technical stuff. Tax and trust was most popular, and a lot of people asked for our guest to actually join us, which we're very pleased that Utmost stood up and said, yeah, we're happy to get involved in this one, and John will join in as well. So I'll let John introduce himself in a second. If you're not used to the software, on the right-hand side of your screen, there is a chat room, which some of you are using already. Feel free to post any comments or questions inside there. I'll keep an eye on those, and I'll fire those at John as we go through the session. There will be a full replay of this available on this site and on the Utmost site afterwards. And at the very end, I'll give you a link where you can go and get a copy of the slides and a CPD certificate as well from Utmost. So that's enough from me. Hello, John. Welcome back. I'd like to just get you to say a quick hello, who you are, and a bit about Utmost.
Yeah, sure. Yeah, so good afternoon, everyone. For those of you who don't know me, I've been in the industry since 1990 through various sales-based roles, supporting consultants, being a consultant, and then training and technical roles as well. In terms of Utmost Wealth, some of you may not be aware of exactly who we are, but you may be aware of a fairly small French company that used to be in the wealth management market until October 16, AXA. So AXA, as you may recall, was split into three parts. Elevate platform went to Standard Life. The standalone traditional products went to Phoenix Life. And what was the AXA Wealth International business was purchased, and we're now trading as the Utmost Wealth, under the Utmost Wealth brand. In terms of recent headlines that you may have picked up on, last week we just completed our purchase of the Generali Pan Europe book, now trading as Utmost Pan Europe, but that actually doubles our assets under management, and we're now the second largest offshore bond provider in Europe, and there are more acquisitions coming through the pipe as well. So as our CEO says, we expect to go into next year with 30 billion under our belts. So things are getting serious for Utmost.
Thanks, John. And again, we're really pleased that Utmost actually stood up and said they'd actually have a try at these events, which are all new. So thanks very much for supporting the paraplanning community. Right, I'm going to make John's slides nice and big now and hand over to John. And don't forget, any questions, pop them in the chat room or the question box right down the bottom of the screen, and we'll fire those as we go.
Thanks, Rich. So yeah, as you can see, what we're gonna tackle today, as Rich said, for the next 45 minutes or so is inheritance tax and pensions. Where I really want to get to for you is to highlight the areas in which inheritance tax can still feature with respect to pensions, because there's this big thing that pensions are IHT free. Most of the time that's true, but it's not necessarily true all of the time. So we'll tackle the areas in which that can happen potentially, and also we'll just think about the Pension Freedom's death benefit regime and what that represents to people, and where perhaps the use of a discretionary trust for death benefits could actually represent something a bit more fitting for their needs and objectives in terms of passing funds. So, starting at the bottom, at the basics, really, we know that when somebody dies inside a pension scheme, defined contribution here, we're sort of concentrating on, there are options potentially. The option is to pay out a lump sum, as you know. And what was, I think, one of the biggest changes from April 15 was the ability to pass your pension fund on to anybody, essentially. As you may recall, before April 15, you could only pass your pension fund on to pay income to a survivor if they were a dependent of you as the member. As you know, that's now gone. So you could pass your pension fund on to Fred at the pub if you nominated them and the scheme provider decided that they could have a survivor's drawdown. So that was the biggest change. And as we know, that means pension wealth can be passed on very efficiently. The pivotal point, as you know, is age 75. When tax starts to to bite in terms of income tax specifically, and that presents some thoughts for different individuals in terms of how they may plan and work around that age 75, depending upon what they want to achieve. And as you know, when it passes,
just on the age 75, John, I'm saying we just got involved in the first case where we've had a fund that actually was taxable at the date of death, but then the survivor died under 75, so it became tax-free again. So
exactly what I was just going to say.
Last owner, isn't it?
Absolutely, yeah. This whole thing. So it's not about it's about the age of the person who died. So as Rich said, if I died under 75, my beneficiary, my survivor, would have a tax-free income. If they held on to over 75, it would then become taxable to their beneficiary. If they died under 75, it would go tax-free again. So it doesn't stay in the same tax mode. It is a very powerful way of passing wealth on. But as we'll see a bit later, although that's massively powerful in terms of tax efficiency, what you lose, if it's a concern of yours as the member, is control over where it ultimately goes. And that's where a trust might actually be applicable to some people, as we'll see. Now, I thought it'd be useful just to think about the kind of process that a provider may go through when one of their pension member dies. And the first thing they may begin to think about and ask is a binding nomination in place. So by that, I mean, has the member given the scheme an instruction, a binding instruction to say, this is who I want you to pay to, without discretion. For those of you that go back a while and dealt with AXA in the past, and maybe Sun Life going back that far, they had a form called an allocation form, which was basically a binding nomination. So you could actually choose who you wanted to have income from your pension pot, and that's good. Some people would like that, and rather than being subject to discretion via nomination, they have certainty that that's going to happen. The price of that, though, as you may know, is when you make a binding nomination, you then have to think about inheritance tax. So if you're making a binding nomination to your surviving spouse, who automatically qualifies as a dependent, then that's fine. But you also have your spousal exemption in terms of inheritance tax, so it doesn't cause any problems. But if you made a binding nomination to your son or daughter, then inheritance tax could feature there depending on the size of the pot and so on. So it could be suitable for some people, but be careful who the binding instruction is pointing to. If there isn't a binding nomination, and let's face it, there's probably not across the marketplace, the next thing the provider would think about is there an integrated trust in place? And by that, I mean a trust that essentially wraps around your policy. Rather than using the expression of wish to get to a trust, you're wrapping it around. So rather than relying on the pension scheme trustees to make decisions, you've put your own trustees in place, and they're making the decisions in terms of where it goes next. That's good as well, because before April 15, before the big changes, that was also another way for pension members to get certainty over what would happen, because they knew that if a lump sum was paid from that pension scheme, it would have to go to that trust. No discretion in terms of where else it could go. Discretion sat with the trustees. So that gave people certainty. Not in the way it's arrived at. So a bypass trust. So some of the other things I should say as well, some of the terms I might use in a while: pilot trust, bypass trust, as Rich just said, where we're talking about those. That's where you may establish a trust during lifetime, maybe put £10 to it to give it some certainty, and then you point your expression of wish to that trust. That's typically been used as a spousal bypass. And if you think about what happened in April 15, it took away that need, because people used spousal bypass trust in the past to stop any lump sum potentially hitting their spouse's estate and then creating further IHT problems in the future. I would say now pension trust, bypass trusts aren't really about tax in that sense. It's more about control over where things might go next, because you haven't got to worry about the other aspects you can pass on. But integrated trust, so AXA did have an integrated trust, and that did actually achieve the bypass, because they switched off certain things after taking opinion on it. But I suppose, to all intents and purposes, a bypass trust is generally pointed to with an expression of wish. If you do come across an integrated trust, then just be careful how that's sitting in the big picture of pension freedoms, because the provider may or may not be able to then provide income. It might be overridden. So be careful what the rules say. So if there's no binding nomination, no integrated trust, we're now saying, is there an expression of wish? And if there isn't one, or even if there is one, as we know, you're now subject to trustees' discretion. And they could decide, after looking at the individual's life and so on, to pay to certain beneficiaries or to a trust potentially, or actually pay the estate. And that's not as bad as it sounds if the trustees decide to pay the estate, because the general position is, as long as they make that payment to the estate with discretion, through a discretionary process, then there shouldn't be inheritance tax payable. So an example of that is where, seen this in the past, you might have a pension fund of £20,000 and they wanted sort of 6 different payments out to different beneficiaries. It might be easy for the administrator just to pay to the estate and let the personal reps dish it out to save admin time and so on. So there's different ways they can play it. And obviously the route discretion could take is to look at any expression of wish that exists and decide what they're going to do there. But as you know, it is just an expression of wish. It's not binding. One other thing you might want to think about in terms of backing some of this up, if you're involved in the will writing process, or have any comment or input to that, it's probably worth mentioning the individual's pension assets in the will, because that may be some of the biggest value assets they have. In saying that, whatever it says in the will doesn't create any binding on the pension scheme trustees. It just gives them more evidence, I suppose, of where the individual may have wanted things to go. So it can be a useful piece if the expression of wish is unsatisfactory or out of date. It might be they refer to the will. So in summary around that, if you make a binding nomination, then you could lead to an IHT assessment, because if it's not going to the spouse, it's going to be in your estate. Nominations can be binding or non-binding, and Revenue confirmed after April 15 that the nomination, this thing of passing income on to an individual, can just be an expression of wish as you've seen it. What you might see now these days, though, since the changes, if you make your expression of wish, it might have some tick boxes on there. Do you want income to be paid? Do you want a lump sum to be paid? But again, that's not binding on the provider. They could still make those decisions. So in terms of the inheritance tax position, we know this stuff. If we're, depending on the member's age, doesn't matter if it's 75, under or over, IHT shouldn't feature. If we're paying out an uncrystallised fund lump sum, or drawdown for that matter, inheritance tax shouldn't feature. We've still got the 2-year window, but the 2-year window has changed. So previously, if you took more than 2 years to pay out a death benefit as a pension scheme provider, you would then trip into inheritance tax in the previous regime. Since April 15, we still have a 2-year rule, but what happens there is if you go beyond 2 years before you pay out, it's almost like the member died when they're over 75, and then the benefits payable to the beneficiary are then income taxable in that way. So there is still a 2-year window to get things done. So if you're dealing with a SIPP with property in that's proving difficult to sell and so on, you have to be careful. Or family feuds and things that could push things on could create that situation. Now, in terms of the wider position, the general position is we shouldn't have inheritance tax, but there are some wrinkles that we need to be aware of. And that's really driven by your IHT reporting. So IHT 400 is your main reporting form. The thing that kind of walks around the car and kicks the tyres for the Revenue is IHT 409, because that's the one that asks questions about pension schemes you have that are not state pensions and so on. And it's looking really for activity that's gone on around your pension and how that may have been treated. And the first one we need to think about is annuities. So you may have come across this. So if you have an annuity individual who dies and they die within their guarantee period, what can happen is your remaining guarantee payments can actually be, although let's say you've died after 2 years and you've got 3 years to go in terms of payments, although those payments will continue in reality as a stream of income to the beneficiary, actually Revenue could turn them and capitalise them into a lump sum to add on to the estate. But there's a big depends upon this. And the next slide shows that really, because it depends upon who purchased the annuity. So going back to my sales support days in the 90s, I remember the old Sun Life form. for annuities, when they offered annuities, had a tick box on it to say, do you want to purchase this annuity in the name of the member or the name of the trustees? Now, if it's purchased in the name of the trustees have discretion over where those remaining guarantee payments go. So it shouldn't cause a problem because we're back to discretion. However, if you come across any cases or put any in place where it's the member that purchases the annuity, then this can happen and you can have this situation. So you can see here, there's a link on that page as well. If you can skip back there, Rich, sorry. And there's a link on that on the page there. There's a PDF document that Revenue offer with the link that you can actually put things into, so it's not frozen, and it's a calculator, and it can actually work out for you how much this is worth for estate value purposes. So I don't know if you can see the numbers on your screens, but from memory, I think we've got a 5-year guarantee here, and there's a period of time to go, and I think it's a £30,000 gross annuity. Yep. And subject to basic rate tax. So what they actually do is take the annuity after the recipient's tax has been levied, so basic rate in this case, and they then turn that £24,000 into the capital lump sum with the calculator, and they've laid out assumptions in terms of rates and so on that they use and factors they use. So you can see that this 30 grand guaranteed annuity for the next 5 years or so is worth £95,000 in the estate of the individual that's died with the annuity. So be careful. Again, if it's being paid to the spouse and it's in the name of the member, you've got your spousal exemption. So you should be okay. But just watch out for the structure of the annuity and where it's being pointed to.
Yeah, I've used that calculator before, and it's good. The link's on the previous slide. I got a bit triggered.
It's on previous. Yeah, I can't quite see mine. It's probably my eyes. My eyes that are too old. And then, of course, as I've said a few times, if you're paying out a death benefit as a pension scheme trustee, then you need to pay with discretion as far as you can. But just beware of those pension schemes that some of your clients will have, and maybe some of the most important clients, because you may have accountants and solicitors who are on the books as clients who may well have older pension contracts. So think about old retirement annuity contracts, precursors to personal pensions. And section 32s and such like. They don't have a trust around them as a pension scheme. They are an entity in their own right. And if they're not in trust, you can't pay with discretion because it will just be paid out as a lump sum and will form part of the individual's estate. So if you come across any clients with old retirement annuity contracts, old section 32 contracts, that's when you need to wrap a trust around them. And a discretionary trust is typically what's used there to make sure that doesn't hit the estate. But there's a bit more to that in terms of wrapping a trust around a policy, because as we'll see in a minute, you have to think about the client's health and what that may do. So we're building this picture. As long as we pay with discretion, we should hopefully be okay. Or are we definitely okay? And that's where the 2-year rule starts to kick in around activity you've taken with your pension scheme within 2 years of death. And that's what the 409, scheme 409 can bring out as well. So the first one, I'm sure you've come across is contributions. So this is really there to catch somebody who pays in a pretty sizable sum of money into their pension scheme and dies within 2 years. Now, if you think about it, Revenue have said really that pensions shouldn't be inheritance tax planning vehicles, but things are kind of set up in that way really, because if you have somebody, let's say you're dealing with somebody who's 65, 70 or whatever, and they have a drawdown policy, they've cashed out and they're just taking their drawdown, they can still use carry forward. Because they've got an existing pension policy, and they could conceivably pay £160,000 into a pension scheme using carry forward. They won't get tax relief, or they'll only get tax relief on 3/6, but they could pay a pension contribution. What's the benefit of that? Well, they could be building up further fund, further tax-free cash and so on. But the other thing to be aware of is the IHT position, because in good health, if you make a pension contribution, there is no 7-year clock for yourself anyway in terms of your pension contribution. So it's gone from your estate. And if you survive 2 years, it's absolutely gone. If you die within 2 years, that's when the revenue could, as I say, start to walk around the car and kick the tires and say, so why did you do that then? What was the benefit ultimately? But if you survive 2 years, you're getting money out of somebody's estate, and that's better than a 7-year clock. Just be careful, I suppose, around the environment we're in now with DOTAS and so on, and the general anti-avoidance rules around that. But on paper, there could be something there really. And as you can see, 409 asks that question, and it's asking about pension contributions you've made into your own pension policy, as well as pension contributions you've made to third parties as well. Because if I paid a pension contribution for my own policy, then I survive 2 years, it's gone. If I pay to a third party, the net contribution I pay is a potentially exempt transfer as far as revenue is concerned. So that could then have a 7-year clock on it. So it'll dig out something else as well from that position. So contribution within 2 years, watch out for. In terms of trusts, we just talked about Section 32s and retirement annuities and such like, and putting a trust around them. And we've got this pilot trust, the spousal bypass trust I described earlier, where we can use expression of wish to point to the trust, or we could use an integrated trust and wrap it around the policy. This is again where you have to be careful as far as IHT is concerned. Because if you remember what I said earlier, if you use an integrated trust that wraps around the policy, you've taken away discretion from the scheme trustees. I think Rich has gone there. You've taken away discretion from the scheme trustees, and you've passed it to your own pension scheme or your own trustees of your trust. And there is no discretion in that way, not from the pension scheme itself. So what does that mean? It means if you wrap a trust around a policy of this type, or even a normal personal pension, you die within 2 years, then you're into this position that you could actually have IHT levied because you've wrapped a trust around it. And that contrasts directly with using a pilot trust, where you point your expression of wish towards the separate trust. What happens there? Well, the trustees are still in control. They've still got that discretionary decision to make, whether they pass it to the trust or they pass it to others. So you could have somebody who really doesn't want to pass their pension fund on to somebody else for whatever reason. They want to use a trust. If you go down the integrated trust route, they could have an IHT problem if they die within 2 years. If they use a pilot trust, then they should be free from any inheritance tax challenge, because the pension scheme trustees have still got discretion over what happens. So that's all good in that way. Before Rich departed, he's skipped us on to the next one, which is handy, to do with pension transfers. So again, another link here to a 2-year rule around pension transfers. So what happens here, if you transfer your policy and you die within 2 years of transfer, then revenue can again look at why you did it. The things have moved a bit here. There was a case, if you're looking for some bedtime reading, look up a case called Parry and others versus HMRC from a couple of years ago, and it weirdly actually related to an old AXA policy, an old Section 32 policy, I believe. But what revenue actually say is, when you transfer from one pension scheme to another, you're going from one trust to another, essentially, and they regard that as a potential transfer of value. Now, if you transfer when you're in good health, then they would say that is a nominal transfer value. They're not worried about it. But if you transfer and you knew you were in ill health, so you might take the example of somebody in a defined benefit scheme where their death benefit isn't a decent lump sum, it's a return of their contributions, and they decide, well, actually, I'm looking at a £700,000 cash equivalent transfer value here. If I move that over to a personal pension, then I would have a £700,000 payout on my death. However, if they die within 2 years of doing that, then they may well suffer inheritance tax on that. And weirdly, revenue take the stance that if you're sitting with a pension scheme, you could direct, as we said at the beginning, you could conceivably direct payment of your death benefit directly to the estate in a binding fashion. So weirdly, they regard it as a loss to the estate, even though people don't generally do that. That's what they would do. So they regard it as bringing to an end the trust you're in and moving to another trust. So to be clear, if you transferred in good health and you had an accident and died within 2 years, you should be okay. It's all about, I suppose, the intent when you transfer. If you die within 2 years in ill health and you knew you were in ill health, then you've got this problem. Now, if it does come to pass that you do need to pay inheritance tax on this, it's deemed to be part of your estate, but some people have mentioned the spousal exemption if the ultimate pension fund is passing to your spouse. But Revenue have confirmed that doesn't apply, because the pension fund is deemed to be part of your estate. It adds to the numbers, but it's not part of your estate. Therefore, they've concerned in this circumstance that the spousal exemption wouldn't apply, even if the ultimate beneficiary was the spouse. So it could be quite costly, and it could also foul up other things as well. As you can see, it would then be regarded as a chargeable lifetime transfer that would then start hitting nil rate band, maybe impacting upon other lifetime transfers your client made in the 7 years before they died. So not a great place to be, really. So think about, if you've got somebody in ill health and you want to use a trust, think about the type of trust you use, whether it's spousal bypass, i.e. a separate pilot trust, or integrated. Think about that there. Think about contributions and the positive thing that could do for individuals in good health, but think about the downside if they were in poor health as well. I think Rich is still in the background pressing the slides. He is. That's good. Yeah. Now, in terms of coming back to drawdown and the bigger kind of picture, just a bit of a case study here to see where a trust could potentially fit. So your client is a guy called Charles, who's 73, and he's got a couple of children. But just to complicate things for him, his children are from his first marriage. And what he'd really like to happen is when he dies, his wife gets income from his pension pot. But when he dies, he wants to have some certainty that his kids will benefit from that pension pot. But that's kind of a problem. And I've had this question in the past where I've been asked about this life tenancy on the pension fund income, in the same way as you could have an interest in possession trust via the will, an IPD trust, as we've talked about before. As you know, that really doesn't happen. If Charles died and he passed his pension fund on to his surviving spouse, Sandra, as a survivor's pension, as a dependent's pension in this case, she is now in the driving seat. And she then decides, as you know, where it goes next. And that may not be his kids from his first marriage. So, as I said at the beginning, pension freedoms is enormously powerful in terms of tax efficiency. But if your client is more about control and where things might end up, then that could be something to think about. Think about it as well. He's also got problems with his daughter still living at home. He's 73. She's still living at home. She's not really good at looking after money. Again, if she inherits his pension pot, if he were to die now, remember, she can draw out the whole pension fund or whatever she receives tax-free. And remember as well, there is no age limit. She could be 30 and pull all of the money out. So the wealth would be lost. She doesn't have to be 55 to pull that money out. So it's enormously powerful, but quite costly in terms of control. And the other thing I'd throw in as well, we've talked about different bits here. The other thing to consider here in all of the pension freedoms regimes, we might wax lyrical to clients about, yep, and you can pass your pension fund on to your children, your grandchildren potentially. That's all true technically, but don't forget you are limited by the rules of the pension scheme the member is in. So if they were to die in a pension scheme where the rules haven't been updated, and remember the pension freedoms rules were an overarching option. They don't have to be adopted by the scheme provider. I think most have, but you do come across some scenarios where they haven't. What does that mean? Well, it means that they might not be able to provide a pension to a child, a grandchild, for example, under 18, that their scheme might not be geared up to pay to a minor, in which case they're stuck. Because if you die in a pension scheme, the survivor's pensions, the initial survivor's pensions, have to be established with the scheme you die with. you haven't got an open market option to say, okay, XYZ company doesn't provide the survivor's pension that's required, so we'll transfer to ABC company to get the right options. So part of this as well in terms of planning is the housekeeping. When client reviews happen or at other times, try and do some housekeeping on what the scheme is actually capable of, because you've got your overarching technical framework, but you've got the scheme rules and the proposition to market and what they can actually achieve. So Charles has got this situation. He wants income for his spouse, and he wants the kids to get the capital effectively. Now, think about another little wrinkle that you may have come across. Let's say, for example, Charles has died. Sandra, his wife, is still alive, but he didn't get round to completing an expression of wish or a nomination. The question then is, what can the trustees actually do? And this is a little wrinkle that is worth knowing if you haven't found it before. And it comes back to this: who can the scheme actually make a nomination for? And when I say nomination, it's i.e. who can they pay income to? Well, the nominee, as you can see, is somebody that the member chooses, so Charles in this case, or that the scheme administrator chooses. And you can only be a nominee if you're not a dependent. But let's remind ourselves, Charles has died, Sandra has survived him, his dependent has survived him, and the kids are still around as well. The wrinkle is that the scheme administrator can only nominate somebody if there are no surviving dependents of the member, and Sandra is his surviving dependent. So in practice, that means if they wanted, for whatever reason, through their discretionary powers, they did decide to pay the children, they would not be able to pay them a survivor's pension. They would only be able to pay them a lump sum. So again, it's back to this thing we've talked about, I'm sure you heard endlessly, about making the expression of wish or the nomination a living, breathing document, perversely, that is reviewed with the client regularly to make sure it reflects their wishes. And the other thing you might have come across is the 9811 story. So i.e. you put your spouse and your children on the expression of wish, 98% to my spouse, 1% to each of the children. Now, the start point for that is to tackle this, to make sure that all the potentially interested parties are named so that they have all the options, i.e. income or lump sum. However, just before the AXA was sold, in our last round of seminars, we were corresponding with Revenue on these particular pieces, and Revenue did confirm that it can get to the point where the spouse is offered the benefit. So let's say it goes down, so the 98%, back to that, he might say, that 98%, I don't want that, I'll take 60, give the other 40% to the kids. And the quite grey area that Revenue confirmed is that where that is turned down by a spouse, if it's actually become a formal offer and it's gone beyond the discretionary process, they are then giving up a right to a benefit. And that can then mean you're into unauthorised payments, essentially, because they're giving up that benefit. So you have to be careful on the 9811 strategy with spouses, changing how much they're lined up for ultimately. But in saying that, in all the time we've had pension discretion, it hasn't come out that way, but Revenue did confirm that ultimately. So in terms of what the position for Charles, the trust versus nomination, we know the picture. 75 is the line. He could nominate and use that tax-free up to 75. The beneficiaries pay their marginal rate of tax before or after 75. And as we know, if we can end up receiving a pension fund, that's got to be better than receiving the lump sum, because you're going to enhance the value of your estate. So anytime you can receive the survivor's pension, that's great. So Pilot Trust might suit Charles because he can obviously make sure that his wife Sandra benefits, but he can also make sure that the children benefit, because the trustees will be looking after the money for him. It won't be in the lap of the pension scheme trustees, or Sandra for that matter, where things go next. But the problem is this, as you know, tax-free, payable to the Pilot Trust before 75, but we're going to tax after 75, and you can't tax a trust like this at the marginal rate as you would an individual, so there is a flat charge of 45%. And just incidentally as well, in the previous sessions we've talked about discretionary trusts and the 325,000 limit for somebody who hasn't done any other gifting before. When you're paying out a benefit from a pension scheme, it could be £1 million pension fund, and you wouldn't have that initial charge into a pilot trust or an integrated trust, but you would then have potential periodic charges and so on later on. So in terms of this, considering the pilot trust, we know under nominee pension, if Charles dies pre-75, we're exempt from tax. If we go down the trust road, though, as you'll recall from previous sessions, although we're now going to have no tax going into the trust, we're then into an additional rate world, essentially, above that first £1,000 of income. We could be looking at 45% income tax and so on, 38% on divvies. However, as we touched on before, if you use the right wrapper inside the trust, i.e. a bond in this instance, we can essentially control income tax. We've got a non-income producing asset. And we can obviously work with assignments and so on to get money out efficiently. We can also not have to worry about capital gains tax because it's a non-CGTable vehicle. So really that boils you down to, for those that want to use the trust, periodic charges. Can you stomach the periodic charges? What you have to think about is the tax that's being saved, because it's not in anybody's estate, and the 6% will only be on the bit above the nil rate band. So that can work pretty well for them. However, as I say, when you hit 75, you're into that 45% tax charge. And that's where people might say, I really like the idea of the trust, but now I'm not so clear on this because I'll lose potentially nigh on half the pension fund to get there. So is control really worth that much? The good news is, if you haven't come across this, there is a little wheeze or part of legislation that can ease that position, and that's by way of a tax credit that was agreed in legislation. So what they basically said, and in driving this legislation, what they were looking to do was make things comparable to receiving a pension fund and having income paid out, paying the marginal rate beyond 75. What this means is you get a tax credit with the income you receive from the trust. You can claim tax back. So let's see how that works. So let's say Charles has got to 78 and his 300,000 drawdown has now got to £340,000, and it's being paid to the separate trust. The trustees have agreed the expression of wish, off we go. So we pay 187,000 to the trust itself. 153,000 goes off to revenue as the 45%. So not so good at this point. However, there's a tax credit. So if the trustees paid out £10,000 to a beneficiary, it's actually worth in the beneficiary's hands £18,181, i.e. grossing up by the 45%. So if you were paying that out to enough non-taxpayers, as you can see from the table, you could reclaim all of that £8,000 and get back to the net £10,000. As you can see with basic rate, you'd pay 3,600 broadly on 18,000 of income. You could potentially reclaim £4,500 of tax. And the trustees can keep doing that and whittling that 153,000 tax credit down. So if we click onto the next bit, Rich, there on the next box, they've paid out that credit there, and it's reduced that tax pool down to 144, I think it was. So they'd keep doing that until that got down to zero. So it's not absolutely perfect, is it? Because although it's put things on a par with respect to income tax payable, you're still only then paying across the 55% to the pension trust. So you're missing out on the growth on the other 45%. So it's not absolutely perfect, but it might be enough for some people to think about, that in terms of keeping control. So what's he achieved with this? Well, he's now in this position. He's got the knowledge that his wife Sandra will be looked after by the trustees. It's not in her hands as to where the pension fund goes next. It's not a pension fund anymore. It's been removed from that regime. So the trustees can now decide where it goes next. If he really wanted to, he could make Sandra a trustee of that trust as well. But she would obviously have other trustees there. So in the UK, if you have a number of trustees, unless the trust instrument says otherwise, they have to have unanimous agreement to make a decision as to where they go next. So it could be that she's got a place at the table in terms of looking after the money and so on and how she benefits, but she's not fully in control. So it depends upon what he wants to do. Equally, his kids from his first marriage can be beneficiaries of the trust. So his daughter that he was worried about doesn't have free access to the money, and then can't spend it willy-nilly. She'd be making a case to the trustees ultimately. And the other thing I haven't really mentioned, outside of any of the of stepchildren potentially, is, you know, surviving spouses that could be particularly vulnerable after they've lost their long-term partner and so on. They could be swindled out of money because it might come to pass from some con man or other who knows that they've got access to this 300,000 fund that they can draw down on in whatever proportions they want to. So the family wealth could be lost. Equally, if the pension fund were paid out to the children, ultimately, if they end up in marriage failures potentially, if the lump sum's been paid out, or business failures, that could be brought into account, and almost certainly will be brought into account. Whereas if it's in the trust, you're in a bit more of a secure position. So it's all about making sure you're protecting wealth moving forwards. So yes, the pension freedom regime for death benefits is tremendous, but it might not be the full story for everybody in terms of that position. And of course, the other route is that they like the use of the trust up to 75. They still can't stomach the 45%, even with the tax credit beyond 75. So what do they do then? They could then supply a different expression of wish. And I have actually seen some examples of pension companies' expression of wishes where they do have kind of a split expression of wishes. I don't know if any of you guys have seen that, where there's an instruction up to 75, and then after 75 it says I'd like you to consider these options. So you could actually have a form that does both. And don't forget, if you want to fill out an expression of wish to suit needs, it doesn't have to be from a technical perspective, it doesn't have to be on the company's expression of wish. It could actually be a free form letter. But it depends upon the company, depends upon their systems. And equally, you don't even have to provide percentages in terms of beneficiaries and where it might go. But you may have to, because the scheme provider wants percentages for their system if they're going to administer it. So it's worth asking these questions of providers to see how you might play it. If you are going to supply your own free form instruction, just be careful that it is worded appropriately, i.e. you don't want it to turn into a list of instructions. If this is the position, do this. If that's the position, do that. Because one challenge that pension scheme trustees could have is that they haven't operated discretion, i.e. you've just formed a set of instructions this member has given you, and you've basically done what they asked for. So it becomes a binding nomination. So it's got to be nice and fluffy in terms of understand you've got discretion. Here are some thoughts of mine that may assist you in your decision-making process, that kind of thing. But really, for me, the big message is in all of this, make sure you understand the schemes that you're using with your clients, and I'm sure you do. But it's those little horror stories where you hear that there is no drawdown facility over 75, for example, or no drawdown facility under 18 or for minors. So make sure that's okay. Make sure you understand what the scheme's offering. Make sure the client's in the right place. Review the expression of wish ultimately to make sure that is absolutely spot on in terms of how they want to do things. And the big thing as well is I think there's been a view that pension trusts are kind of dead since April 15. I don't think they're dead. I think they've been kicked a bit, but I don't think they're dead, and they've still got a place for the right client ultimately. So that is about it from me. I don't think Richard could get I'm just reading. Richard couldn't get back in there. So thank you all for tuning in. If you have got any questions, then please go to the big tent and put those in there. Hope that's been useful for you, and maybe dusted off some stuff that you picked up and have forgotten, and maybe hopefully given you some new things to think about as well. Thanks for your attention. See you next Thursday at 1 o'clock to think about family investment companies and where they may fit in the planning process for clients to sit alongside trusts. Thank you very much.